Good morning, everyone, and welcome to Ask a Property Manager episode 39. Today is September 23rd, 2020. We're coming to you from Studio 2.0 here at Own Buffalo. I'm Andrew Shouldnt, Principal Broker of Own Buffalo, Inc. And on today's show, we're going to be looking at why banks should not try to flip houses and what happens if a super hot real estate market suddenly stops being hot. Before we jump into that, we're going to go ahead and plug our social media. You can find new episodes of Ask a Property Manager every Wednesday live on Facebook, 10 a.m. Eastern Standard Time over at facebook.com/Buffalo Foreclosed Homes. You can also catch replays on our Facebook page as well as on our YouTube page. Catch our YouTube over at youtube.com/ownbuffalo. And don't forget to follow our Instagram as well. We post a little bit different content over there as compared to the other two platforms, and it's definitely worth taking a look at. Don't forget that we also offer free 30-minute consultations over at ownbuffalo.com as well. You can see I do have a couple of time slots available here for this week, and then it looks like I have a couple of time slots available for next week as well. And last but not least, don't forget about the Rent Prep for Landlords podcast. New episodes of the podcast drop every Thursday morning, tomorrow. This week's episode, we're going to be looking at how to disclose flood issues. We're also going to be looking at a little bit of the rules and regulations surrounding installing security cameras into the common area of an apartment building and what to do when a tenant wants to break the lease early. So don't miss out on that. You can catch that over at rentprep.com/podcast or anywhere podcasts are heard. So today I want to jump into, we're going to go right to desktop here. I want to cover a news story. This is printed by Housing Wire. This came out yesterday. Sales of existing homes surged to a 14-year high. We'll get into this in just a second. But what I want to do here is kind of go through this article and show you that, yes, home sales are surging, but that is also creating a lot of hot markets. I wouldn't go so far as to say bubbles, because I don't think that we're quite at that point, at least not in my market. I can't speak for every market. But I want to show you what happens when a hot market suddenly stops being hot and prices in a neighborhood decline. So let's get into this article here. Sales of existing homes surge to a 14-year high. Looks like I'm going to have to refresh this page. Looks like I'm not going to be able to refresh this page. Essentially what it boiled down to, let me see if I can pull it up in another browser. Give me 1 second. Oof. Okay, well, we got the article. It's full of ads, but we got the article at least. All right, so we'll go through the article here real quick. August sales rose to a seasonally adjusted annual rate of $6 million, according to the National Association of Realtors. Sales of existing homes rose to a 14-year high of $6 million in August, per the National Association of Realtors, said in a report on Tuesday. Combined sales of single-family homes, townhomes, and condominiums and cooperatively owned apartments rose 2.4% from July, according to the report. Compared to a year ago prior to the COVID-19 pandemic, last month's sales were 11% higher. Home sales continue to amaze, and there are plenty of buyers in the pipeline ready to enter the market, said Lawrence Yoon, NAR's chief economist. Further gains in sales are likely for the remainder of the year, with mortgage rates hovering around 3% and continued job recovery. The median home price last month was $310,600, up 11.4%, and prices rose in every region. The number of properties on the market at the end of August totaled 1.49 million, down 18.6% from a year ago. Down 18.6% from the year month ago. So that would be last year, same month. Unsold inventory, measured as a month's supply number that gauges how long it would take to sell all the homes if nothing else came on the market, was 3 months. That's down from 3.1 months in July and compared with 4 months at last year. Cheapest home financing costs on record are driving demand for homes. Mortgage rates have reached new lows 9 times since the Federal Reserve began buying mortgage bonds in March to expand access to credit, according to a weekly survey by Freddie Mac. The average U.S. rate for a 30-year fixed mortgage increased 1 basis point to 2.87 last week, second lowest on record, rising from the prior week's all-time low, Freddie Mac said on Thursday. The less popular 15-year rate fell to a record low of 2.35% last week. So essentially what we're looking at here is sales of existing homes surge to a 14-year high. And they're talking about both the number of homes and also the value of homes. So we have, it appears, across the entire country, a relatively hot real estate market. It's good news if you're a seller. It's not necessarily good news if you're a buyer. If you're in a buyer position, you know, a lot of times you're facing multiple offers and stiff competition, things like that. And you may find yourself in a position where you're contemplating overpaying for a property. And I want to show you why overpaying for a property is simply a bad idea. So we're going to make this simple math just to make this as easy as possible. We're going to say that you purchase a price in October of 2020 for $100,000. Actually, let me jump over to, I'll show you the math on this first. So what I'm using right now is my deal analysis tool. If you'd like a copy of this, you can send me a message either via ownbuffalo.com or on Facebook or on YouTube. Drop a comment. We can get this over to you for free. It's a nice little template. It allows you to work up a deal analysis on an investment property and also do mortgage calculators and amortization tables. So we're going to say that in October of 2020, this month, well, next month, you're going to buy a home for $100,000. You're going to pay a 3% interest rate, 30-year mortgage. But we're going to say that you're an FHA buyer, and that means that you're putting 3.5% down on your $100,000 or $3,500. That means that you have a loan amount of $96,500. We're going to say that this loan starts 10/1/2020. Let's see, monthly loan payments, total interest paid. I'm not going to factor taxes in here because that's not the purpose of this, what we're doing here. So you can see your monthly loan payment is going to be $407 a month. Let's jump over to the amortization table here, and you can see that your mortgage does start on that October 1st date, and that for every payment you're making some on the principal, some of the payment goes to the principal, and the bulk, especially at the front end, is going to interest. It doesn't really, let's see, where's the match-up point here? So, I mean, you're not until 2027 that you are matching up here. There you go. Kind of like right in there. You're basically 2027 before this would, before you would start paying more principal than interest. But essentially what I'm looking for here is how much am I paying in principal for the first year that I own the property? So here's the first 12 months of principal. And you can see down here at the bottom, actually it looks like I'm blocking it, but the total sum here, I've got one more month that I need there. Total sum of all of these principal amounts for year one is $2,015. So with that knowledge, we're going to go back to our other sheet here. What happens if the market drops? So you're going to say in this example, we purchased a property for $100,000. We put 3.5% down on an FHA. If you're in a VA position where you're putting 0% down, this is a much worse situation, potentially a much worse situation for you, not having put anything down as part of your down payment. But we'll use the 3.5% down for a loan amount of $96,500. So we're going to take our $96,500, which is our loan amount, and we're going to subtract out our first year of principal payments, which was the $2,015 that I pulled from the spreadsheet back here. That's your first year principal payments. Which leaves you with a remaining loan amount of $94,485. At the end of year one, you go to a real estate broker and you say, hey, what's my property worth? I want to see if I've got equity in my home. Well, they tell you that unfortunately, at the end of year one, your property value has dropped by 5%. The market adjusted down, and your property that you bought for $100,000 is now worth $95,000. Minus what you owe on that loan, your $94,485. How much equity do you have in that home? A whopping $515. All of the equity that you've paid into the home, all of the principal that you've paid down, was immediately eaten up by that market drop. And I understand that this is a very simplified version of this. There's other things that would go into, you know, if you truly were going to sell the home, you're going to have other expenses that go into it, and you're underwater even at the 5% value drop at this price point. Now let's look at a 10% value drop, which means that you're going from a $100,000 purchase price to now a market value, a home value of $90,000 after year one. Now, taking away, you know, subtracting out that remaining loan, the $94,485, which is what you owe on that property after the first year's principal and interest payments are paid. This is your initial loan minus your principal that was paid, the $94,415. Holy cow, you're underwater $4,485 in your first year if there's a 10% value adjustment. So it's something to keep in mind. And obviously the situation gets better the longer you own the property, even if the property value does adjust down. You know, the more equity you have, the less impact you're going to feel from something like this. But if you're buying a property at peak market and then that market adjusts down and you're coming in with a low down payment option, something like an FHA or a VA mortgage, even some of the smaller conventional mortgages that might only have a 5% down payment or something like that, you know, you really could be putting yourself into a nasty situation where you're now underwater on a property. And when we say underwater on a property, that's what we mean, is essentially you owe more on the property than what you're going to make by selling the property. So it puts you into a bad position, and it's not necessarily a situation that is cause for concern. If you're planning on owning the property for 10 years before you sell it, and you're underwater in year one, well, you still have 9 more years to see what the market does in terms of the property value. So it may not be, you know, a huge issue in that scenario, but, you know, at the end of year one, let's say you have a job opportunity to move across the country and you have to sell this house here in Buffalo. Well, okay, now I'm underwater on this house here in Buffalo because I bought it at the peak and the prices and blah, blah, blah. You know, it's not a good situation that you could find yourself in. The best way to protect yourself from a situation like this is well, there's a few ways. Number one, make sure that you're buying properly. Buy a property that's priced right. Buy a property that's not overpriced for the market, and make sure that you understand what the pricing in the neighborhood is doing. If it's climbing, if it's sinking, things like that. Understand what it is that you're buying and the comps in the neighborhood when you go to purchase your property. And understand that what you're doing is purchasing a property and it's a snapshot in time. The property value on the day that you purchase it is the agreed upon value between two parties. The next day, the property might have a very drastically different value. Somebody could drive a truck through the property. It's going to change the value of the property very, very quickly. So something to keep in mind, you know, if you're buying property out there right now and you're buying property top of market, make sure that you're getting a good deal, that you know what you're buying, or alternatively, the best way to ensure that you don't find yourself underwater, put down a larger down payment. I understand that, you know, a 20% down payment, conventional, it sucks. It's not fun. It's not what anybody wants to do, though that's typically what most investors are doing, is 20 to 25% down. But when you're going in on a deal and you've got 20 or 25% down, you know, there's a lot more room if there's a market adjustment. So that's just something to keep in mind. That's my thoughts on what happens if the market were to adjust, given our current market and given the fact that people are buying properties at what I would consider to be near the top of the market in a lot of areas. So that's my 2 thoughts on that, my 2 cents on that. Now that we've kind of covered that, the next thing I wanted to talk about was why banks should not flip homes. And I'm going to pull up some photos here of a property that I went and looked at last night with a client. And I want to critique a little bit the quality of the work that we found. So for background, I'm not going to say the name of the company that, the name of the bank that flipped the property. I do know what bank it was, but I don't want to call them out because I'm hoping that this is something that they'll come back and correct at some point, but I have a feeling that they probably won't. So we went and looked at a foreclosure yesterday evening that was listed, and I don't remember the number of days on market, but it was surprisingly high for this market. We're in a market right now where things that are, you know, properly priced, good properties that are properly priced are moving very, very rapidly. And this thing had been sitting for, it might have even been a month or so at this point. So we kind of figured that there was something more to it. The pictures look nice, but we kind of figured there was something more to it before we even went out to take a look at it. And what we found is that the bank had foreclosed on the property and made a determination that based on the, you know, the amount that was owed and the amount that the property would sell for, that there was enough of a window there for them to rehab this property and put it back on the market to hopefully try to offset some of their losses. And I can't stand it when banks do this. I would almost always rather see them just sell the property, dispose of the property, and move on. Because when banks do flip projects, I can almost guarantee you they will not go well. So typically what happens with banks, and I'll kind of explain a little bit of the process here. When a bank takes on an asset that's been foreclosed on, they'll send in a contractor to do a few basic things. Either usually winterize the property, Make sure all the water pipes have been drained, the hot water tank has been drained, run antifreeze through all the drains to clear those out. Essentially make sure that there's no water in the pipes that would cause them to burst when it gets cold. The same contractor might be responsible for lawn care and landscaping, snow removal, doing a rekey on the property, doing a trash out on the property, basic maintenance type stuff. What the bank will do is sometimes they will take, rather than get a real contractor that they have to pay actual money to, they'll try to take one of these property preservation contractors and have them scope out what it would cost to rehab one of these properties. And when it comes to the banks, obviously they want everything done at the best possible pricing, which is why they tend to use the cheapest possible contractors out there to try to achieve their goals. The problem comes with the cheapest contractor out there generally is not going to be the contractor that provides the highest level of quality, which is what we're going to see in these photos as we start to flip through them. If banks were doing this the right way and going out and hiring competent licensed contractors to do these flips, you would get a much better project, you'd get a much better end result, but it would cost the banks a little bit more money. So instead what you're getting is a subpar product on the market that everybody loses because, the homeowner's going to come in and they have a home that immediately needs repairs. The bank is paid for the substandard work, and whether or not they'll get the work fixed, under warranty by the contractor is anybody's guess. It's just bad for everybody in the market. It does nothing to help, neighborhoods to improve. This house especially. I didn't take any of the exterior photos, but I should have because there was some stuff outside that was pretty nasty as well. But let's get into these photos here. So this is like a vinyl plank, like a stick down vinyl plank flooring. And you can see here there's a gap between two of the planks. This will become a recurring theme. So this is another shot in the same room. And essentially what had happened is the contractor did not leave enough. They installed trim at the far end. So if we're looking at the photo, the wall would be up on this end of the photo here. So they installed trim up there, but they didn't leave any room for the floor to shift and move as it would, just normally as a house shifts and moves, the floor has to adjust with it. They left that trim tight on there so that the floor couldn't adjust. What ended up happening is two of the planks ended up buckling up against each other, pushed together, and now you have two planks that are, one of them's cracked. You can see there's a crack here, so this one's broken. You have a ridge here, and that's never going to look right. And again, it just goes back to poor workmanship. Another shot of the same thing. You can see the ridge there. This is on the other side of the same room. This plank is just completely popped up. It was never installed properly. You can see right here, you also have another line of separation. This was a carpet that was installed. So you can see they left a crack here that was not patched. They didn't bother to trim this out correctly. They didn't bother to clean anything. You can see there's paint overspray. Like, this is the quality of work that I'm seeing in a lot of these bank-owned properties. And this was a property that was listed for like $150, I think. $140, $150. I'd have to go back and double check. But, I would expect a little bit better quality even in that level of home. Like, it's not like you have to expect perfection at that price point, but I would expect if somebody's going in and paying for work that they would get better quality results than this. So this is kind of fun. All of the carpets in every single room were cut short and not actually installed properly. Proper thing to do here would have been to pull this trim and make sure that the carpet actually ran all the way out. I don't even think there were tack strips in this room to hold the carpet in place. Let's see. This is another spot where you could see all the lines in the flooring. They didn't bother to undercut on the trim here and tuck the flooring the way they should have. It's just all of these little corners that, even the transition strip, you've got a gap here, you've got a gap here. Those should be tight. It's frustrating. This was in one of the bedrooms. You can see there's literally a gap. By the way, you should never have quarter round, which is what this little piece of trim here is, or shoe mold. You should never have that in a room where there's carpet. There's no reason for it. The carpet could go right to should really tuck right under the existing wall trim there. It just looks like garbage. And this is, they literally tucked and just cut this tiny little piece of carpet and tucked it in here. I just happened to notice it because I was looking, but yeah, like they used a scrap piece of carpet and just kind of tucked it in there to try to make it, and you can see a little bit of the tack strip. Just very, very poor quality build. Then one thing I noticed in the bathroom is they had installed a tub surround, just a very basic tub surround. And when I went to push on one of the walls, I noticed that the wall of the tub surround moved, the thin plastic of the tub surround moved. And then I realized that, and this is a shot, this would be the shower head right here coming out of the wall. So this is the shower head coming out. And then this would be the top of the shower wall. So this would be the basically the plastic insert that they had put in. They didn't attach it to the wall properly, so it's already starting to separate off of the wall. And you can see that there's, they didn't bother to do anything at the top here in terms of either a trim or a caulk or anything like that. So you're going to have water that will eventually infiltrate in back behind there over the course of time and create issues as well. So that's my thoughts on, let me see if I can switch back to, So when you're dealing with one of these bank properties, you really have to be cautious. If it was a bank that did the flip, or really any flip, to be honest with you, you have to be cautious about, are they just putting, lipstick on this and trying to get it out the door, or are they actually going in and doing a quality job? So, take your time, look at the house on a little bit deeper level than just a surface. If you walked in and looked at this house on just the surface level, you probably wouldn't think all that much of it. But when you start looking at it, just past the surface level, you don't even have to scratch that deep. Just past the surface level, you start noticing the issues. So that's something to keep in mind. The best ways to protect yourself in a situation like this are to get a home inspection, because all of this is stuff that a home inspector is going to notice. A lot of it is cosmetic in nature. I'm not gonna argue the fact that a lot of what I'm pointing out here is cosmetic, but it looks like crap, and it's definitely going to cost the homeowner money to fix this stuff. And if they're cutting corners on the cosmetic stuff, you can bet that they're cutting corners on the more important stuff, the mechanical stuff. So definitely get a thorough home inspection. That's critical when you're dealing with a property like this. The other thing you can do, check to see if there are any records of permits or violations with the code enforcement agency. So contact your local municipality, whether it's the town, the village, the county, whatever. Contact the code enforcement division and see if they have any open or closed permits or open or closed violations against the property. That might give you an indication as to whether or not somebody was doing things the right way and pulling permits, or if they were just trying to kind of do things the way they wanted to do them, and code enforcement hasn't been in there to actually check to see if anything was done correctly. And last but not least, just understand what you're buying. Having that home inspection report and being able to arm yourself with that knowledge will get you a long way in understanding what it is that you're buying and whether or not you want to proceed with a transaction like that. So this is good information to use on really any flip project, but specifically, I've noticed this a lot on the bank projects. The other thing is most banks don't have a local person that is managing the project. They have a contractor that is sending photos back to the asset manager, who's probably not even in the same state. You may not actually have a local project manager who's checking these projects to make sure that the quality is there. And there's a lot of things that can be hidden in photos. So I notice this a lot more in bank flip projects than I do in local flip projects, like people who are flipping homes here locally. And honestly, most of the local home flippers that I know anyway want to put a good quality product out on the market because it's their name. Banks don't care. They don't live here. They don't live next door. They don't live in your neighborhood. So for them to slap a lesser quality product on the market, it's really no skin off of their back. So that is my soapbox on why I think that banks should not be rehabbing homes. I think that they should just be selling these properties as is and letting the local investors, the local home renovators take care of these properties, get them back on the market, and get them back into the hands of the community. So that pretty much wraps things up for us here today. Thank you so much for joining us. I really do appreciate it. We love producing Ask a Property Manager, and you can definitely help us to improve by dropping a question in the comments either on Facebook or on YouTube. Your question may be answered in an upcoming episode. If there's something that you want us to cover that we haven't covered, you can drop that in a comment and we'll look into doing an episode tailored around that content as well. We are looking for more and exciting topics anywhere that we can find them. So if you have an idea for a topic or there's something that you're looking to learn about, let us know. We'll see if we can put something together. If you enjoyed this content or brought some value to your day, please do us a favor and hit the thumbs up button. YouTube and Facebook both push videos based on community feedback, so every like, comment, subscribe, and share helps us to grow and reach more people. Next week on September 30th at 10 a.m., we're going to be back with another show you won't want to miss. Thank you all so much for watching, and we'll see you next week.